Hello traders, hello everyone. Welcome in the advanced room here at Life Education with XM. My name is Marcin Nowogorski. We're gonna have this session together. We're gonna talk about Forex patterns, all sorts of patterns that you will bump onto while Forex trading. Of course, there are and there will be more patterns because patterns are evolving. Market participants are trying to find and utilize them and exploit them, and therefore other traders have to adapt and not let those patterns make them lose money, right? Because if there is any pattern, if there is any pattern in behavior of market participants, then there is someone on the other side who tries to exploit that pattern for their benefit. And so people who are following that pattern being exploited start noticing that this is a losing pattern, that they rather lose money on it than make money on it. So this way, if they want to stop losing money, they have to adapt, they have to adjust their strategies and stop behaving such a way, or they lose enough money to stop trading at all, and also they are gone from the market. So the pattern changes because there is nobody to lose money on it, so there are no money to be made on that pattern for the other side. So then new patterns have to emerge, new patterns have to be created. So setting up this rule, because trading is a competitive game, trading is almost zero-sum game. It's negative sum because of commissions, but a part of that, one person's profit is another person's loss, and one account profit on one account is loss on another account, and that is the founding, let's say, principle of trading. It's like physics. Like, you can't really have profit that's not someone else's expense or someone else's alternative loss, so lack of profit. This is something like, if we talk about stocks, you might argue, okay, what happens if I sell the stock halfway in a rally, then somebody else buying it, and stock rallies further, so we both make money, right? Well, technically, but there is always, like, there is different time of taking profit, and someone else has to buy the stock more expensively, so potentially taking higher risk of the fact that stock goes down later on. So in the correction, so those losses materialize in corrections, in companies' bankruptcy, in companies' demise, because there are companies that slowly just lose relevance, slowly lose market share, slowly lose, like, their product gets out of use, and so there is usually someone at the end who loses money on the stock, right? Like, when it's going down, you either hold it or you sell to somebody else, so that other person loses money while stock continues going down. So in a sense, there is big time shift between profits and losses, because people tend to buy and hold, and stocks tend to rally, tend to go up quite a lot. On Forex market, especially in short-term trading, this is, let's say, simpler, more straightforward, more direct, especially if we are trading contracts. So you have to basically, you can't go from one currency to another for a very long time. You'd rather be buying and selling fairly quickly, right? So your profit has to be covered by someone else's loss. Your loss has to be covered by someone else's profit, and the money is just transferred between accounts, either within same brokerage firm, or if you and other people use different firms, then there are intermediaries who settle transactions between themselves, like aggregate those transactions and settle the net outcome. Anyways, patterns are simply a manifestation of behaviors of market participants. Very simple example is double top, which is essentially a result of additional supply appearing at a place where previous supply came in, right? So you've been seeing market participants selling here. For example, like that's just basic trivial example. You've been seeing market participants selling here for the first time after nice gains. So of course, having nice short-term gains triggered some take profits from those people, so it triggered some selling. And not many people were happy to chase it and keep buying the top here, so they just stopped buying. More people started selling. And of course, people who were trying to chase were in a difficult situation as markets started pulling back rapidly. Um, the thing is, when price tried to continue, people noticed that, okay, or assumed, apparently, that the previous high is actually high enough, right? Like they apparently didn't believe the price going to get higher, so started taking more profits, started shorting maybe, and then we had enough supply over the demand that actually drove price. Of course, it's all near term. It's like weekly intervals here. The time frame is 4 hours, so those intervals are weeks. But the idea is that, okay, if that price is relatively high, we don't expect in the short term that it's going to be higher, right? So it's like pretty much typical behavior. And then what is important, you can see that this support was still, like, people still had appetite for buying, right? The only thing that triggered more selling was just more supply, right? So it could come from anywhere, from the fact, it might have been fueled by some data, it might have been fueled by Reserve Bank of Australia, it might have been fueled by something else. It might have been some big seller just needed some extra currency, so he's seen extra demand, he just sold more onto them, and then everybody was like, okay, so let's sell. It's important to understand that it's reactionary, right? So the market is reactionary to what is happening, and the price goes path of least resistance. Even when it creates patterns, it goes path of least resistance. So a person who sees double top, and as I said, I'm using it as a simplified example, a person who's seeing double top and assuming that, oh, sorry, and assuming that this is a natural consequence of that, um, is essentially wrong. He's he's missing a serious part of this pattern, very, very important event, the fact that sellers were still determined even here above this new low, right? So we had this neckline kind of support. And neckline support is pretty typical, okay? Neckline support is pretty typical. That's one of those places where we expect buyers, where we expect something important to happen. The fact that we expect buyers here, of course, doesn't mean that they have to be winners, okay? It doesn't mean if we expect buyers at some level, or we expect sellers at some level, that doesn't create the assumption of who is going to win, because, well, new seller may come, may say, oh, I'm having buying liquidity, I have to sell a lot, so I will sell to all of those people and maybe even more, and so the price goes through. So we don't know that, and no one on the market knows that, right? Because if there are big sellers, they usually don't advertise their plans, right? They don't want to be front run, of course. So what do we see is essentially market testing that level, trying to bounce, and unable to, and starts being heavy again, right? And it's all, as I said, reactionary. The market tests support, finds supply. Interestingly, supply has been found on the pivotal area. So every pattern is like you can simplify it to a range. See, like two tops, two bottoms, looks like a range as well. Might have been moving like that, creating triple top, triple bottom, and so on and so forth. And actually later on it starts ranging, right? It becomes like this kind of a range, which is very typical. But let's focus on what we don't know about. Let's focus on the pattern first, not about what happened later. Um, so essentially, middle middle ground area. It's true for consolidations. It's true um, for those double tops. Even if you look at head and shoulders, you will usually have some middle area, right? It will be like the most traded, pretty much the most traded zone in the maybe it will be like the head will be like that, so you will have it as a support for the head. Maybe shoulders will be trading more around it, and of course the neckline. And usually it's around middle, and it's not even that somebody wants to make it like this. It's just that those flows, because they are all reactionary, pretty much reactionary. Some, of course, are not reactionary. Some, of course, are like deliberate market movers, well, even if big seller wants to unload big position, like here, for example, like I assume that might have been the case here. Um, Even if big seller tries to unload big position, he is reactionary because he is reacting to liquidity that's available. Okay, so he needs to sell a lot. He needs to find plenty of buyers. If he sees plenty of buyers, he starts unloading, and usually gradually. That's why consolidations like that. That's also a pattern. Like small consolidation is like a zone. We like 10 years ago, we've been calling them supply and demand zones, or nine years ago. Right now, I mean, it's all supply and demand anyways. Like if you have a support, it's because it's there is demand concentrated on it, right? But as I said, it doesn't mean they're gonna necessarily win. The market can test it and can check how much supply there, how much demand there is, how much appetite there is for selling. And if they see there is a lot of appetite for selling, and you can see it in price action, like there will be like heaviness, or there will be some other. I'm not even saying you should be selling the pin bar, but here you have been seeing it was heavy already, right? So in a sense, there are always hallmarks, and doesn't have to go for the tops of candles, or whatever. I know everybody's tempted with that, but there are all sorts of hallmarks. Usually like one, two, maybe three candles still give you time to enter. And even if you want to go against the level, like even here, some you had some profit margin, right? Potentially. So it's not that you have to be on the very second top, um, because you also never know if it's going to be failed breakout top, if it's going to be failed breakout that goes into a breakout, or if it just becomes the market like consolidating at this top. Why all those reactions are possible is because the market actually, it all depends on how much supply and how much demand is there, right? Maybe situation would have been opposite here. So some supply was entering here trying to sell the second top, or trying to unload positions above the previous high. That's pretty typical, because usually at this high and slightly above, you're gonna get liquidity. So but there might be big buyer coming in, and actually absorbing all of that, right? So if big buyer absorbs all the short selling and drives the market against them, that's like a tiny short squeeze, right? Also, big short squeeze are pretty much similar, but we are talking about small time frames. So